Stock Play of the Day is an educational program. Any statements made by Ally Invest employees are not intended to be or should be considered investment advice, a recommendation to buy, sell, or hold a security, or a recommendation to adopt an investment strategy.
Hello and welcome to the Stock Play of the Day. Today's stock is JPM and a few other of the financials that are announcing earnings this week. Today we'll discuss, should we pass or should we play? Hello, my name is Brian Overby. I'm the senior options analyst with Ally Invest. I will be solo today. Callie Cox, our senior stock strategist, cannot make it today. So I'm going to jump right into it. We're going to be looking at the VIX watch list to start with today. Not a lot of story on the VIX for the first time in a while, in that the volatility indexes finally came down into the doldrums, down around 15%. We look at the S&P 500 index. We have that up about 0.1% today, trading up $6.30. We have the VIX index at 1596. So we've broken the 16% level. If we look at the VIX chart over here, we see that we've actually kind of stayed down on that level. We had a little bit of a blip last week, but we're really kind of hanging back where we were before the pandemic. So we're trading in that 15-16% range. Looking up at the futures contracts, we see that the August futures contract is now down below 20%. Now, October and September, which are traditionally more volatile months, are trading above the 20% level, which I once again have highlighted on my chart as a fairly important area. Actually was really established because of the pandemic. We kept having the marketplace just not be able to break below that level. So in the near term, volatilities are very muted. And that's also happened in a lot of the stocks overall. Even though we're starting earnings season, we're seeing volatilities come off in general on the entire marketplace overall. So because of that, we're going to use that information. We're going to address a few things. But before I get too far along, let me run in and actually look at what's going on in the markets right now. If we look at the NASDAQ and the S&P 500 index, we have very similar charts. Took a while for the NASDAQ to actually break out to new highs, but now you're probably seeing the headlines. A lot of the FANG stocks are going higher, setting new highs. Apple, Google, Amazon overall are all having really good months so far in July. And we see that today the NASDAQ did set a new high. If we put in the S&P 500 index, we also see that a very similar chart. We had the breakout pattern. We're above the 20-day, we're above the 50-day. We're a little bit overextended relative to the 200-day moving average. A little bit more of a muted move in the S&P 500 index. I'd like to say it's begrudgingly moving higher, but it's still going higher. Having the VIX going lower, we've got the S&P 500 index going higher. The only standout here is the IWM, which is the Russell 2000 index. This is actually the ETF that tracks it. A while back, I actually drew this channel kind of showing that we're really stuck in a range in the Russell 2000 index. Now, the Russell led us out of the pandemic. It was one of the strongest indexes, the small caps. And now we've just kind of seen it be very muted overall. So in general, it's usually a good sign if you can get the small caps leading the way. And that's not happening right now. There are inflationary concerns, and a lot of times that will hurt small businesses more than big businesses overall, but in general, inflations are tamed right now. Right now, the expectation, the 10-year is actually at the lowest point as far as the yield is concerned in over about a month's time in general. So inflationary concerns are a little bit waning, and we're seeing the Russell 2000 index just trade within this range. Now, it'd be very interesting in general, and we might do this on the stock play day, talk a little bit about if we could see the Russell break to a new high here. 234, it looks like, is the high end of that channel overall. That would make the Russell 2000 index just interesting to look at. A little bit tougher to trade in the Russell 2000 based off of charting. It's just a little bit more schizophrenic, if you will, as far as its stock prices overall. So that pretty much sums up the marketplace. Like I said, a little bit boring to talk about it because we got the VIX down around 15%. S&P 500 index just seems to drift towards new highs each and every day. We got NASDAQ finally out of the doldrums and starting to be a market or to be a market leader overall in the tech stocks and the tech space in general. So today we have the kickoff of earnings seasons, and in particular, we have 7 big banks that are going to be announcing earnings this week. Now, I want to take this opportunity since I don't have Callie with me to talk a little bit more in depth about the marketplace. I want to use this stock play of the day to focus on option strategies. Now, as always with the stock play of the day, it's not meant to be a recommendation. We're just looking at how we can take plays that are inside the options playbook, the book that I authored, and how we can apply them to current market conditions. Now, we've just talked a lot about implied volatilities coming down, not only in the indexes, but also in a lot of individual stocks. And that is definitely the case in the financial sector. Very strong markets overall. If I look at just in general, the XLF, which is an ETF that tracks the financial sectors, you see that we've had a very strong 2021 since the beginning of the year, up about 25%. Now, the market has given back a little bit of the gains in the financials or the XLF, and that's mainly because what has happened with the 10-year, and that the financials would like the interest rates to go higher, have a little bit better yield curve, if you will. And right now, the 10-year being at lows for the first time in a few months, as far as the yield is concerned. The marketplace didn't like that and that information overall. So right now we've given back a little bit. Earnings are coming. Marketplace, as far as financials are concerned, had some good news in that the government gave them their okay to work with their dividends, maybe do some buybacks overall after their big audit. So there's been some good news mixed with a little bit of the bad news. And I guess the bad news overall would be that interest rates are coming down, in particular on the longer term yields. Okay, so how do we address this? What's an option strategy that we can use to still participate in the banks after this big run up so far, but also not have all the risk of just buying the stock outright? And I've been building this quite a bit since the pandemic, since we came on the other side of the pandemic, the economy just getting a little bit stronger overall, as a FOMO trade, a fear of missing out. Yesterday on my midday market call, we talked about this strategy using Disney overall. Today, we're going to just look at the financials. Now, you can decide which financials that you would like to address. Goldman Sachs and JP Morgan announced this morning. And because of that, I'm going to look at both of those underlyings, and I'm going to talk about the differences as far as the option strategy is concerned. And I think it's just a great example overall of how I would approach this strategy on these underlying stocks. Okay, so I'm going to highlight inside the options playbook the strategy that I'm talking about. Right here, we're talking about buying LEAPS calls as a stock substitute. Now, LEAPS just stands for long-term equity anticipation securities. It's just a fancy name that the Chicago Board Option Exchange came up with to talk about longer dated options. It really does not mean they're not any different at all, except for they usually have longer term expirations. We're not going to go out to a LEAP. We're going to go out to January of 2020. We're going to get out to the next year overall, but we're going to still, all the concepts that are in the options playbook and in this section of the option playbook, we're going to focus on. And in general, if I scroll down a little bit, one of the things that I'm going to highlight right here is looking for an 80 delta. That's our goal. We want to get something that will represent the stock price movement. We'll give you a lot of that stock price movement. A delta of 80 means that if we buy that option contract, first of all, it's going to be an expensive option contract relative because we've got to go deeper in the money to get delta. But if we buy that, we should get about 80% of the stock price representation. That means that if we bought 100 shares of stock and the stock went up one, we would expect to make $100. If we buy an 80 delta option contract and the stock goes up one, we should expect to make $80. Now, that's all in theory, but it gives you a basis to start with when you're buying your option contract. So we're buying a real option here. Now, we're going to limit our risk, just like with all options. If we bought out of the money options at the money option contracts, our risk is still defined by what we pay for that option contract. So in this situation, we're going to be paying some dollars, but we will know that that is limited risk as far as our portfolio is concerned. Okay, so let's start out, and we always have an official paper trade. Once again, not meant to be a recommendation. So we're going to make the official paper trade in JP Morgan. And in particular, the 7 banks are going to be announcing earnings this week. We got Bank of America that's going to be announcing, Wells Fargo is going to be announcing. This morning, JP Morgan announced, and also Goldman Sachs announced. So we're going to look at the 2 that have announced. Now, I'll explain a little bit more after we get into detail. Let's look at JP Morgan. Let's set up the stock play of the day, if you will, and then we'll discuss why I chose to focus on the 2 stocks that have already announced earnings this week. Now, I have no opinion on where they're going to go in general. We're just trying to learn here on the stock play of the day, and I want to emphasize that. All right. So if I go back and look at the Ally Invest option chains, we see JP Morgan after the earnings announcement, and they had a fairly decent run up yesterday. So did Goldman Sachs overall. But today it's down about 2.5%, trading at 154.10. On the left-hand side of your screen, you see that we have calls, and JP Morgan is at, as I said, 154.10. We're going to go out to the January 21st. This is the monthly option contract, 2022. It's 192 days out. And as I said, inside the options playbook, we're going to focus on an 80 delta. And guess what? 80 delta is right here. That's the 135 strike. So it's exactly at 80. Now, we look at this market, it's 2235 by 2275. All right, that means that if we were going to buy 100 shares of stock, now you got to have this concept. If I was going to buy 100 shares of stock, I would have to put up $15,416 in order to buy 100 shares of stock. Now, concept would be if I was going to buy 100 shares, I'm only going to buy 1 contract. I'm going to buy a surrogate for that stock. Another way to say it is I'm going to rent the stock as opposed to own it. Part of the reason why is that we've had a big run up in the financials. We are getting into earnings season. Maybe I'm a little nervous, but you know what? I've already missed out on a big move and I don't want to miss out on any more. And hence the term FOMO, fear of missing out. But I have limited and known risk by doing this. I'll have a position that will take advantage if the market continues to go up in this specific underlying overall. All right. So 2255 is the midpoint. You can't always get midpoint fills on longer term option contracts. And that's one of the headaches of buying leap options. If the markets were tighter, this would be an extremely popular strategy, in my opinion, in that I can get a lot of the representation of owning the stock with not all the risk overall. So why wouldn't I do that? Well, why? Because I have wide bid-ask spreads. I'm 22.35 on the bid if I were to sell my option contract. I am 22.75 on the ask if I were to buy this option contract. So we have right now, well, about a 50 cent, the market's moving, but about a 50 cent wide bid-ask spread. Well, if we look at the stock, it is now right now 2 cents wide or 1 cent wide most of the time overall. So that's a big difference because you think about this. If you bought this and said, oh, never mind, and sold, I would lose 50 cents on my $22.75 option contract. That's a decent percentage of the overall price. So I would work the order a little bit overall. This is not a bad market for a stock in general. And a lot of times, because of the earnings, a lot of people are trading this, and that adds a little bit of liquidity. So I specifically like to look at these type of strategies after an earnings report. And also to go along with that is prior to that earnings report, if we look at where the volatility was at, let me go and look at the nearest term option contract and see where vols are at right now. Okay, we see vols at around 24%. The implied volatility of JPM prior to this event yesterday was trading around 35% implied volatility. So volatilities have came off quite a bit. And if you're buying option contracts, removing that implied volatility risk is definitely a benefit. I don't want to pay that juice for this big earnings report. We've had a big run up in the underlying stock. We had no idea where the underlying market might go. But if I bought it before earnings, I'm going to pay an inflated premium because of that known news event overall. All right. Balls have came off. Once again, this is a live show. Markets are rocking and rolling. So we always got to double check our quotes and see where we're at when we're talking on the stock play of the day. So let me get rid of that shorter term. This is the July 16th, just to get the noise out of here. And we scroll down and we see, okay, this will be our official paper trade. We'll put it in. The midpoint is 2240. If I were to try to trade this, I would try to work it. I'd give a little bit more than the midpoint. I think I would shoot for maybe 2250 to start with. Now, midpoint fills are anywhere between the bid and ask are never guaranteed. You're always hoping that you can get a fill in between those prices. A little bit harder if there's not as much volume or not as much open interest overall, but I might start with that. So we're going to make the math simple. We're going to say we're going to risk $2,250 versus buying the stock outright, which would be about $15,400. That's going to lower our overall risk down to about 15%. Now, you might say, Brian, 15%? What are you talking about? I'll just buy the stock and sell it if it goes down 15%. Yeah, that's true. One of the things, though, that is also true is that a lot of people, especially beginning investors, have problems selling stocks that are down. Usually, they hold on to stocks that are losers too long and sell winners too quick. That's been my experience over about 30 years of doing this. One thing about options is I guarantee that that's the maximum that I can lose if I'm doing this on a one-for-one basis, if I'm not using that leverage factor. If I'm buying one contract versus buying 100 shares, if I wanted to buy 200 shares and that was my thought, I would buy two contracts, et cetera, and so on and so on overall. Okay, so that would be our paper trade. Buying open one contract, January 21st, 2022 expiration, 135 strike call, trading with a delta of right around 80 cents. Okay, now I want to highlight how we can also go to the next step and reduce our risk even more. Okay, so most of the time when you're buying an underlying stock, unless you're doing if you're buying it long term, you might just buy and hold. You might be bullish on the underlying, just buy and hold it for the next 10 years and get a quote on it every year and just see where it's at, right? In this instance, you have an option contract, so you have an expiration date, so you need to pay a little bit more attention. But if I look at the profit and loss graph right now, I'm going to zoom in on this. This is a good old standard call option. We see that buying in the money option contracts are interesting in that if the market goes up, our profit and loss graph, the dotted line is highlighting at expiration what our profit and loss is. Now, this is all in theory inside the Ally Invest profit and loss graph overall. But you see on the upside, we quickly get to the dotted line. And what that implies is the delta is dynamic. As we go up, we pick up delta fast. The most delta could ever get would be 1. And that makes sense because an option is a derivative. It's derived from the stock price. You should never receive more in benefit of buying a cheaper priced vehicle than you would if you bought the underlying outright, right? So if the stock goes up 1, you're gonna make $1 on your 100 shares. If the option contract goes up 1, you should never make $2, right? It just makes, in theory, that makes total sense because you didn't pay as much as you did for that underlying stock. So ultimately, if we see the colored line morphing into the dotted line, that means that the delta is now 1. It means it's acting a lot like the stock. Now let's look at what happens on the downside though. If we are incorrect in our forecast, the market comes down towards our strike, the 135 strike, I want to set an alert there. I want to know when it gets to 135. Why is that? Well, that's where all the time premium kind of sits. When we have a longer dated option contract. And so because of that, that's a buffer that protects us. Guess what? Our delta slows down. We have a delta of about 80, but if the market comes down to 135, that delta is now going to be around 50. It's going to slow down on the downside and give us a little bit of protection. Now, if it moves down in the short term, well, the more time premium that we have, the more protection that we get. But obviously, we'd like the market to go up. I'm going to highlight this because we have 192 days to expiration. So let's cut the time in half. Let's go down to, let's call it 90 days. Okay. A little bit off from half, but approximately. And now you see that that dotted line has changed quite a bit. Now, keep your eyes focused on this. Let's go back to 192 days. And we see that it's up a lot higher here. We go down to 90 days. Now, all of a sudden, you start seeing that line start to morph into the dotted line at expiration. Okay. So it gives you a small buffer. And this is the way I kind of like to look at it, in that I'm risking a total of 15%. But if the market comes down and I'm maybe down 10% on my option contract or 7%, William J. O'Neill used to always say, never lose more than 7% on a stock, no matter what. That was his goal, his way of investing. This is one way that you can do that. You just say to yourself, okay, you can do one of two ways. You can look at the price and say, we're going to pay $22 and some odd change. I don't remember exactly what it was. 22.20, down a little bit. 22.50 is, I think, what we said. So I'm going to, I can lose $22.50. That would be my maximum that I could lose on this trade, or about 15% of the underlying stock price. I can say, if I'm down 10% on that, I'm going to sell it. I'm going to sell it when I get out of this position overall. Or I can say to myself, well, if it comes down to my strike and I can base it off the stock price, it becomes an at the money option contract. That's where this time premium rewards me with the most protection. And that's when I'm going to sell and I'm going to get out. Totally up to you. But the biggest thing is if you have a plan, you want to stay consistent with that plan overall. All right. Now I'm looking at the chat box and I'm seeing a lot of questions coming in. If you'd like to put your questions in the chat box, I'll try to address as many of them as I possibly can. And once again, this isn't meant to be a recommendation. The way that I look at the stock play of the day and everything is that we're trying to learn. All right, we have vols come down. We have earnings just announced. We have a marketplace that has done well so far this year, has a lot of momentum as far as financials just in general to the upside. So how can we still participate? Because we've already missed out in theory, right? Saying, I don't know if you have financials in your portfolio, but if we've already missed out, a lot of people will just ignore it and they'll move on and they'll say, let me go try to bottom fish or find some other industry that hasn't done as well. This is one way that we can participate. When we want to do it after earnings. We like it when implied to the VIX down around 15%. That's also a good number overall. Volatilities in general have came down. Why? Because I don't want to pay inflated premiums if I'm going to implement this strategy overall. Okay. Now, I'm going to also look at Goldman Sachs, which announced earnings this morning. I'm going to talk a little bit more. I'm not quite as excited about Goldman Sachs and this strategy, and I want to explain that thought in just a second. All right. Oh, all right. Charlene says, thank you for doing this. Well, thank you, Charlene. It's always nice to be appreciated. And then I'm going to answer one question here, and then I'll come back to them. So William says, are you saying to help the chances of a guaranteed fill, you basically split the difference between the mid and the ask versus trying to wait for the bid? Okay. So as far as order execution is concerned, I said we put this in the right rail. Let me go back here and I'm going to click trade. All right. And I'm looking at that right rail. We said $2, $22.50. Right now the market's at 22.10 by 22.40. If I put an order in and I say I'm willing to pay 22.30, if I go at the midpoint and I'm using a single option contract, and we're especially talking about longer term options, if I go at the midpoint, it's really hard to get a fill, mainly because the marketplace, I'm not giving the market maker another leg. I'm not giving them all an alternative. I'm not doing a spread. I'm just saying, please fill my order, and I don't want to pay what you say your asking price is. So that usually means that the marketplace has to come in and fill you on that order. So what would happen is if I put this order in at 22.30, you would actually see that's what price I'm willing to buy it at. You would actually see that asking price come down to 22.30. And if somebody wanted to buy it there, you're advertising that price to the rest of the world. Either the market makers could take it or somebody else in the world could take it. Why? Because that's the best selling price that is available in the marketplace right then. Actually, I'm sorry that the bid would come up. I apologize. It would be 2230 by 2240. So overall, because we're buying, no, I had it right to start with. I'm sorry. I'm getting confused. I confused myself there. Overall, never mind. Let's get on to the thought about Goldman Sachs. So if I come back on Goldman Sachs and I look at the same type of trade, same type of thought, I don't mind it on Goldman Sachs, but let's just look at the marketplace of Goldman Sachs. Okay. So we'll put in GS, which is a symbol for Goldman Sachs. They announced earnings this morning too. They are also down about 1.3%. They were up quite a bit yesterday going into earnings. We got the January expiration. If we want to go out, we're going to stay in that expiration. We're going to scroll down in strikes. We're going to look for that 80 delta approximately just to try to keep it the same, right? This delta is 81 and it's the 320 strike. Okay, so now if I look at this marketplace, our bid-ask spread on JP Morgan was $1 wide. Now we see the bid-ask spread on Goldman Sachs it was about 50 cents wide. This is about $1 wide, 90 cents to be more exact. 640 by 630. Okay, that's a little bit wider. That's a little bit more annoying to try to work your order, if you will. So if I'm looking at this trade, I'm a little less excited about it because of the width of the bid-ask spread. I like the strategy overall, and I might work the trade. I might put an order in at the midpoint, see if I could fill somewhere in there. But overall, I have a wider bid-ask spread. Implied volatilities are a little bit higher. We're at about 28%. We have a little bit more expensive stock, which also drives up the price of the option contract. But if you were going to buy 100 shares of Goldman Sachs, you're looking at $37,576. So a little bit different, right? Overall. And the more expensive the underlying, the more expensive that option contract is going to be. So if I put this order in at the midpoint, and I'll put it down, I'll click once over here, that puts a buy, it puts it down here in the actual workbench, and I'll clear up that concept that I was talking about. We're willing to buy it at let's say this is 48,685. Let's go 65. Okay. So a little bit above the midpoint. I'm willing to buy it at 65. We will see that asking price come down because if somebody is going to come on in and I'm willing to buy it. Yeah, I'm willing to buy it at 65. So we're going to see this mid price come up because I'm willing to buy it at that level. So if any sellers come into the marketplace, they're going to want to get 65 from me as opposed to 64.40 from the marketplace, right? So you get that advertisement. That's what happens. That's the way the market would be entered if you put that in there and tried to work that order. But if we go back and look at the volume, there's been no contracts that have traded today. With no volume in the marketplace overall, makes it harder to fill between the bid and ask, just in general. All right. And I see we're at the 12:30, usually the cutoff time, but I think this is a great topic. A great scenario to talk about options. Bank of America is supposed to be announcing tomorrow before the open. I would not want to do this in Bank of America right now because if I look at the implied volatilities, let's just put it in. Implied volatilities because of the earnings and in particular the shorter term option contracts, you'll see quite a bit of an increase in implied volatility. So let's look at the July expiration, and we see that volatility for that short-term option contract is up around 41%. So once again, I'd rather wait. You take the risk that the earnings might be great and they might blow it out of the water. That is the risk. But if I were going to trade this before earnings, I would much rather do either a spread strategy in the options world or maybe just buy the stock because I don't want to have to deal with what can happen to implied volatility after the earnings announcement. Okay. All right. A lot of great questions in here. Okay. So here we go. So Castman says the more desperate, the more you go to the ask standard is in the middle. I on individual option contracts, especially ones with bigger, wider bid-ask spreads, I really wouldn't focus on the midpoint. I don't. I think it's very hard to get fills unless I saw, like, if I'm trading an extremely liquid underlying. Like if I was even in the XLF, I might focus on the midpoint, which has a lot of volume overall, as opposed to an individual stock. I always like to give up a little bit. If I've got a 50-cent wide spread, I want to give up a nickel, maybe a dime if I really want to get that fill above what the midpoint would be at overall. I hope that answers your question. I think I addressed it more than once, and I apologize that I got confused about what would move, the bid or the ask. But I did get it right here. So, hey, so then I got one from Wayne. Brian, would it be a good strategy to sell a call premium against your leap and collect some premium? I wasn't clear why we didn't do that for yesterday's Disney option contract that we talked about on the midday market call. All right, Wayne. Obviously, Wayne is a longtime listener. You can do that, Wayne. But let's just think about in general. The strategy that Wayne's talking about is called a fig leaf inside the options playbook, and I'll highlight that a little bit here. So if we go to the option strategies tab and you buy a longer term option contract, one way that you can kind of hedge that position is you can sell a shorter term option against it. You are covered. It's very similar to a covered call. As a matter of fact, an AKA name we have is a leveraged covered call. But my biggest thing about covered calls, just in general, very rarely do people buy the stock and then just sell the call against that position. Why? Because they're buying the stock because they think it's going to go up. A lot of times they would sell the call after the fact, after a potential move. It goes up a little bit. Now I sell a call because I'm trying to target a price where I wouldn't mind selling that stock at. So if you're doing this strategy, it's okay to do it this way. But we're doing this because we're bullish on the underlying stock. So I don't mind starting by doing the fig leaf. I don't mind it at all. But I'm doing this because I'm bullish on you pick whichever bank you want to look at this week or financial you want to talk about. Okay. So it's okay either direction, but you just understand that if you put this position on and it goes to your short strike, you're going to have to manage that position. If it goes to your short near-term option contract, you either got to think about, I'm going to get out because I don't own the stock. I own an option contract that looks like the stock. Or I'm going to roll that underlying position, which inside the options playbook, we have a section called managing positions overall. All right. Two more, and then we're gonna have to call it a day. All right. William says, I agree with Wayne. Maybe that the next strategy you're getting to. Okay. Understand. All right. Got it. All right, William. So overall, if you are managing, if you do something where I'm selling a call against a position where I'm bullish on it, I see some upside going into the end of the year, I don't mind doing a call option where I sell that nearer term option contract against it. But one of the reasons why we're doing this after earnings is implied volatilities have came off. So there's usually not as much juice in the option contract. And if that market gets to that strike price, I don't own the stock. So I kind of like to let the stock figure out where it's going and then potentially sell a call option against that position at a later date. I think I'm getting to the point where you say I'm beating a dead horse. All right. I think that's going to be it for this edition of the Stock Play of the Day. I will be back this Friday. Maybe we'll look at selling a call option on JP Morgan, JPM. That will be a potential adjustment that we might do to the trade overall. We'll just look at it. So come back Friday, noon Eastern time for the Stock Play of the Day overtime. If you'd like to, please click subscribe and ring the bell, and we'll send you all the alerts for all the stock plays of the day. Thanks for coming, everyone.